So finally, we're going to take a look at problem 233B, and we will walk through that. What this one's going to do is it wants to show you what's that original transaction look like when you purchase supplies, right? And then what's your adjustment look like at the end of the month or the end of the year? How does that impact your financial statements? How do both of these impact your financial statements? Because quite frankly, you're going to end up seeing both of them on that financial statement. So let's walk through this really quickly. Again, this one, I don't think if you've made it through these other B-set problems is terribly difficult if you're paying attention to your dates. If you're paying attention to your dates, it should not be too big of a deal. So let's go ahead and talk about these. What they're going to tell us, again, read for your dates, assume a December 31st closing date, meaning December 31st is when we close the books. That's when all these adjustments have to be made so that we can close our revenue, expense, and dividend accounts. Okay, so the first transaction they're gonna write out for us. Okay, paid $6,000 cash in advance on April 1st for a 1-year insurance policy. So that answers everything we need to know. April 1st, $6,000, 1 year's worth of insurance. So what does that mean for us? Well, it means that we can take this and say, okay, $6,000 times something over 12. What is the something? Well, if we bought it in April and we're recording this on December 31st, we've got 9 months worth of prepaid insurance that we've been able to use up. April, May, June, July, August, September, October, November, December, right? 9 months. So we're going to say 9 over 12. So this means to us 6,000 times 9 over 12 equals 54,000 over 12, which equals $4,500. Okay, so $4,500. This is for the 9 months, right? It's for the 9 months, about $500 a month or so, right? So let us go ahead and get that entered in here as our adjustment, right down here. So we can see the flow of this, right? The original entry is the decrease to cash and the increase to prepaid asset. The adjustment is that decrease to the prepaid asset to get it closer to zero, and the decrease to retained earnings, recognizing that this was an expense for us. Okay. So what about transaction number 2? Well, we purchased $2,400 of supplies on account. So let's start there. So we had $2,400 worth of supplies that have increased. This is going to go under that other assets column. Okay. And our liabilities, that's going to be an increase to accounts payable. It tells us right there, we bought it on account equals accounts payable. Okay. Is there any impact to common stock? No, no impact to common stock. Is there any impact to retained earnings? No, not yet, because there has been no expense recognized. Now, the adjustment, what happens now? Well, we've got to figure out how much of those supplies we've used. And the way we're going to do that, right? The way that we're going to do that is we're going to take our supplies account and just look at it, right? So let's look at our supplies account. It's an asset account. We had $2,400 in it. We ended the year with $200 on hand, remaining on hand. That just means that's what's left, $200. So all we're doing is we're solving for X. 2,400 minus X equals $200. So negative X equals negative $2,200. So our adjustment is going to be a negative $2,200 to our asset account. Okay. What about liabilities? Were liabilities affected? No, they were not. Was common stock affected? No, it was not. Was retained earnings affected? Yes, it was. It's going to be a decrease to retained earnings because it is an increase to supplies expense. That adjustment, that $2,200 adjustment right here is actually a $2,200 expense, right? So we can look at it this way and say, okay, we have supplies, right? We used 2,200 of them. This becomes our supplies expense. Okay, it just moves right here. Okay, so yes, we had an increase to expense, which is a decrease to our retained earnings. Transaction 3. We paid $7,200 in cash in advance on March 1st for a 1-year lease. So answers everything we need to know. How much? $7,200. When? March 1st. For how long? 1 year. Okay, so we know everything we need to know, and we paid it in advance for a lease on an office space. So we're just going to call this prepaid lease or something like that. Prepaid rent really is what we'll call it. So did we impact cash? Yeah, we did. We had a $7,200 outflow of cash for operating expenses. What other asset did we get? Well, we got prepaid rent, right? So now we have this new asset called prepaid rent that we're going to be trying to reduce over the course of this next year. Liabilities, were they impacted in any way? No, they weren't. Was common stock impacted? No. And was retained earnings impacted at all? It was not, because there has been no expense, no revenue, or no dividend. Okay. What about the adjustment? What happens with the adjustment? Well, how long did we have it? March. So we've had it for 10 months out of the year. We got it on March 1st. So 10 months out of the year. March, April, May, June, July, August, September, October, November, December. That's 10 months. Count it on your fingers. It is okay. It is not embarrassing to do it. I, in fact, just did that. So how much did we pay? Well, we paid $7,200, right? So we've had it for 10 months out of a year. So this is going to be 7,200. 72,000. $72,000 divided by 12, which gives us $6,000. Now remember, this isn't for a month. This is for the entire 10 months that we've had it. Okay. So let's go ahead and enter that in. Did it impact cash at all? No, it did not. Did it impact our other asset? Yeah, it reduced our prepaid rent asset by $6,000. Did it impact liabilities at all? Nope. Did it impact our common stock? No, there was no common stock transaction. But did it impact our retained earnings? Yeah, because just like with our supplies expense, we've got the same thing happening here. We've got prepaid rent, right? In the amount of $7,200. Okay, we want to get this down to 0 by the end of the year. However, here we have rent expense. We have to recognize that we've used some of this rent. How much did we use? $6,000. So that's going to go here to our rent expense, which eventually hits retained earnings. Okay, that is what we're doing here. So we have a negative $6,000 in retained impact to retained earnings. Finally, transaction number 4. We received $18,000 in cash in advance for a contract to provide services in the future. It requires a 1-year commitment starting on September 1st. So we got $18,000 on September 1st to go through a year. Okay. This is going to be an unearned revenue for us because we've not done anything as of September 1st to earn any revenue. However, they did give us cash. They gave us $18,000 in cash, which means now we owe them $18,000 worth of services or goods or whatever the case is. Okay. Did we impact liabilities at all? Yes, we did. We got an $18,000 deferred revenue. We have to provide a service. We have to provide a good in order to satisfy that debt. Did it impact common stock? No. Answer is no. No impact on common stock. Does it impact our retained earnings at all? Not yet, because it's not impacted that income statement. It's not hit our income statement yet. It's all still just living on our balance sheet. It's not hit revenue. It's not hit expenses. Okay. So when we make the adjustment, then it's going to impact our revenues. Then it's going to impact our expenses, whatever the case is. But right now, it's just a timing difference. So did we impact cash when we make the adjustment, right? How do we make the adjustment? Again, I'll walk you through that really quickly just so we see it as many times as we possibly can. Again, $18,000 was the amount, right? Times how many months? Well, we know it's for a year, so it's over 12, but how many months? Well, it started in September, October, November, December, 4 months, right? So you got 18,000 times 4, which is going to be 72,000. Divide that by 12. That's going to give you $6,000. But remember, again, it's not per month. It's $6,000 for that 4 full months that we had this liability. We're going to recognize $6,000 worth of that $18,000 in revenue. Okay, so let's go back to our sheet really quickly. Okay, so what asset was impacted? And we didn't have any other asset impacted here. What happened to our liability? Well, we satisfied $6,000 worth of that obligation, so it decreases. No impact on common stock. We've not talked about it yet. And what is the impact on retained earnings? Well, when we earned it, when we earned that $6,000, we get to count that as revenue. So we're going to increase our retained earnings by $6,000. So, and that is that for the BSET problems. I know I didn't do 18, but 18, just go through and look at the definitions for it. It's really pretty simple. I just wanted to walk you through these slightly more complex ones. So if you have any questions, please contact me, let me know, and we will get together tomorrow.